Coming up on today's episode.
So we'll never refinance anyone for the sake of refinancing you, right? So it's pretty open and transparent in terms of the rate that you're getting from the bank. Although the banks like to try and hide it and make it difficult for you to try and actually find it online sometimes. But once you know what your rate is, if you're talking to us and we're doing a review, we'll first of all talk to your existing bank and see, is that the best rate you can offer, or can we get you a discount? Because if we can get you a discount with your current bank and we don't refinance you, you save the cost of refinancing. Right, so we'll get quotes from your current bank and the top 5 or 6 other banks in the market. So then it can be pretty clear in terms of the rate that you're paying versus the rate we can get you elsewhere, and then what the actual dollar cost saving is going to be. Because if it costs you something like $1,000 to switch banks on average, by the time you factor in discharge fees, government fees, and potentially a application or package fee at the new bank, it's going to make financial sense for you to actually switch.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together. Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and property market. I'm your host, Jo Agresta. Now, on today's episode, this one is for our buyers who are confused by the mortgage process. And most importantly, we're going to talk about how to borrow like an investor, even for your first home, because structure and strategy is everything. So we'll show you the way to set up your home loan today so you can upgrade or invest sooner without getting lost in all the jargon. And my guest today is Lewis Johns, an investment lending manager from the Australian Lending and Investment Centre, or better known as ALIC. And they are a multi-award winning brokerage known for its ethical and long-term approach to lending. So Lewis, thank you so much for being on the show.
Hey Jo, how are you? Thanks for having me.
Of course. I'm so excited to have you on because when, we've had a few false starts with this one. You were sick, I was sick, and now we're here, and I'm so pumped to actually get this show on the road.
Yeah, that's the joys of having young children. There's a never-ending stream of sickness in my household.
Oh, yeah, that's true. Oh, that sucks. And it's interesting because, you started out, I remember when we caught up, you're from the UK originally and you moved to Australia, and now you're helping people make, smarter property moves like from the ALIC front. Like, it's very interesting how you've kind of gone through that shift.
Yeah, it's been, I started off in the UK as a mortgage advisor in a bank branch, but this was 12 or 13 years ago. And then moved to Australia, and then I've gone through the process of initially worked for a bank here, and then as a lot of bankers do, so transitioned into broking. And then I've been with ALIC for just coming up for 3 years now.
3 years, that's a long time. So how long have you actually been now in Australia for? Since
coming up for 12 years.
Gee, no, so you're Aussie, like that's
yeah. Yeah, this is very much this is home now. Yes.
Oh, I love it. Well, I want to just before we dive further into your background, because it's always the best place to start, I want to go further into how you started and how we kind of got here. So just to, I guess, for our audience and those listening, some of you have asked for a lot of advice when it comes to structuring loans properly, how to avoid traps. So in this episode, we're going to cover smart borrowing structure, how to avoid the traps that limit your options later, what to do, when to refinance, when not to, and what a really good broker actually does behind the scenes for you. And that's why Lewis is here today. So Lewis, take us back a step, because I think you started out, like you said, your finance career was in the UK. What initially then brought you to Australia, and how did lending differ? Is there much of a difference in what you did over there and versus here?
Sure. So what brought us here, I guess it's a bit of a cliche, but better quality of life, better weather, better opportunities. The UK economically hasn't done great since the GFC. So it never really bounced back in the same way, and Australia didn't get hit as bad. So just had some friends over here, and it seemed like a good opportunity. So myself and my wife, girlfriend at the time, came out here together, and then just thought, we'll go to Australia, and if we like it, we'll stay. So that was it. That was it, really. The transitioning from working in the UK to working in Australia, the financial system is not too different. Because the Australian financial system originally would have been effectively a carbon copy of the UK or the English banking system. So it's not too dissimilar. Probably, and this is going back 12 years ago, so I can't really comment on what it's like over there right now. But at the time, The UK was very much, you still walked into your local branch. So if you wanted a mortgage, you would probably ask your mum and dad who they did their mortgage with, and then you'd get the bus into town or drive into town, walk into your local branch, go and see the mortgage advisor in the branch, and that's how you did your mortgage. So very, very different from where Australia is now, where we've got over 75% of people do their lending through mortgage brokers. At the time, it was very much you still went and saw your local branch-based mortgage advisor, which is what I was at the time.
Yeah, right. And it makes sense, because I think a lot of people here, I think in the same period of time, like about, if you go back 12 years ago, like you said, or, even further in that case, it was the same here. I was walking into your local branch and getting that mortgage advice, whereas now everyone, like you said, 75% or more are using a mortgage professional, which I think is awesome, because you guys have so much more access to lending options. You're not like tied to one product, which I think that's where a lot of banks, it's hard to go to your local bank these days and know if you're getting the right deal.
Yeah, definitely. It's the big difference is the products we've got access to, but also the level of knowledge and expertise that we have. So if you're working for a bank, which I did, you've got one bank's products and you know those products inside out, which is fine, but that's all you know. Whereas when you transition to becoming a broker, you've got to be across multiple different banks. You've got to understand not just products and rates, but also structure and strategy and the investment side of things, rather than just working for one particular bank that might focus on homeowners, for example. Another big difference between the UK and Australia is very heavily orientated to property investing. So in the UK, it's not very common for people to actually invest in properties. So normally people will own a home and then they'll try and pay off their house, and then they'll do their investment into shares or into they've got what they call an ISA, which is a tax-free savings account. So you put all your money into this tax-free savings account, which is either in cash or stocks and shares, and that's the kind of investment path that 90% of the population goes down. Whereas in Australia, we don't have any tax-free savings accounts like that. So the main place where people will try to invest is, we're going to own our house, and then we're also going to try and invest in a property, is what the vast majority of people will do here. So that's probably one of the really big differences between the financial system there and over there and here.
Well, so that's so interesting. And then that kind of, like, now you're in the investment space, that's like your specific niche, is like focusing on that investment strategy. So what kind of, was that your own experience that drew you into that, like specializing in that area?
Yeah, so before I joined ALIC, where we're very investment oriented, I had about 8 years in medical finance. So I worked for BOQ Specialist, which is Bank of Queensland's medical lending division. And then I worked for a company called Credabl, which is a smaller company, sort of a hybrid lender between a bank and a broker, but still focused on helping doctors and dentists with their finance. So that was probably leaned more into the home loan side of things than the investment. And then I got in touch with connected with ALIC, and they sort of explained to me more around how we look at the investment side of things, helping clients not just own their house, but how do we actually help people invest and grow their wealth and borrow money for the right reasons and be more strategic, rather than just that kind of products and rates, which is what the vast majority of brokers out there are doing.
Yeah, that's so true, actually. Like, and I like that you kind of said, like, you've got that expertise. It would have been really interesting working with those professionals, because they're often the most time poor. So it's interesting that there's a whole like department of professionals that look after them.
Yeah, there's quite a lot of companies now that focus on that medical sector. They're clients who are, like you said, they're very time poor. They're obviously very intelligent and well educated, but on their particular profession, which is where they've spent their whole life studying. So then there can often be, well, we've now spent our whole life studying, now we've become a medical professional, become a doctor, and then specialized, become a medical specialist, lots of surplus income, very time poor. What do I do with my income? I want to invest in property, but I'm not quite sure. Where do I start? Who do I speak to? Where do I buy? What do I buy? So there's definitely a real gap in the market for that advice piece around helping people who actually want to invest but just don't know where they what the steps are.
No, that makes sense. And I think one of the other things is that I liked about, ALIC and who where you're working is it's known for being ethical and client first. And you can tell that because the amount of reviews that ALIC has is unreal. What does it actually look like in your day-to-day work with buyers? So how does that experience kind of transpire?
Yeah, so the ethical lending side of things, it's for us, it's we like to say helping people borrow money for the right reasons. So we don't want to see somebody over leveraging themselves and buying a big property and taking on a 30-year mortgage and then spending the next 30 years paying that off and completely sacrificing their lifestyle. So quite often we might, I wouldn't say talk ourselves out of a deal, but we'll be encouraging people potentially to borrow less money and to look at, rather than trying to upgrade and buy the dream home too early and over leveraging yourself, why are you not looking at a more conservative approach in terms of staying in the house you're in now, but then buying investment properties where, yes, you're taking on additional debt, but those investment properties are giving you rental income and tax deductions, right? Which might mean, rather than getting the $2 million house now, we're only looking at a $600,000 investment property, for example.
See, that's interesting. I really like that approach because, there are a lot of different professionals out there that have a different specialty, but often when they're first home buyer focused, or that's what they want to do, their goal is to just get them into a property, but sometimes it's missed this ethical piece of, well, does that make sense for where you want to be in 5 or 10 years? Is that the right option?
Yeah, that long-term strategizing and just understanding what your goals are is really important, because it's not the conversations that we have with a client. It's not just, that's a nice house, how much money do you need? It's where do you see yourselves in 5 or 10 years, right? Why are we buying this property? Are we buying this property just because you want to get into the market and get your money working harder, and you feel like you don't want to be renting anymore? Or are you buying a house because you've got a family on the way, and if you're like me and my wife was pregnant and we had 2 dogs and we had to buy a house to move into. So there's a real emotional driver there. So it's understanding the difference between where do you want to be long-term. The first house you buy is more often than not going to be the forever home. So what does that actually look like in a few years' time? Are you going to be relocating? Are you going to be looking to upgrade? Are you going to be looking to invest? We've got to understand that longer-term strategy. And then that longer-term strategy is going to help us determine what's the right structure for you to put in place now. So it's really important to actually understand that longer-term piece, rather than that's where we talk about structure and strategy. So it's all about, where do you want to be in the next 5 or 10 years? Are we doing the right thing now to actually help you getting there, rather than just trying to max out your borrowing capacity now?
Well, that makes sense. And it leads perfectly into, today's topic, which is structure and rates, right? Because a lot of the discussion, I think, from general knowledge of home buyers, so I'm an advocate by trade, I get this a lot. It's when they're looking at financial options, it's usually based on who's got the lowest interest rate. And that's the criteria that they kind of follow, or guidance that they, go through. But obviously this has to be general and kind of like the atypical experience, because everyone's situation is different in terms of what they can do. So let's talk structure. If I was, let's put it in the driver's seat. If I was a first home buyer, what does a good structure actually look like? And can you break it down in kind of simple terms?
It's not quite as simple. It's really going to depend on your circumstances. Right, so the right structure for 2 different borrowers could be completely different. So for some clients, the right structure might be, we're actually not going to buy a house to move into. So the right structure for somebody might actually be rent vesting. So we might, and we'll sort of unpack and uncover that when we're talking about your longer term planning and where you want to be. So for example, if you are likely to be moving around and changing locations for work, you might look at, well, I'm actually living in a fairly cheap rental property now, and I'm going to keep renting, and I'm going to buy investment properties, right? Because if I buy the investment properties, then I'm going to get the rental income, I'm going to get the tax deductions that are attached to those rental properties, and it's going to be less impact on my cash flow. So that could be the right structure for one client. For another client, they might be a first home buyer and they're really keen to move into their own property and live there themselves as an owner-occupier. So the right structure for them might be then looking at how much of a deposit we're going to be putting down. Are we putting an offset account in place for that client? What are they going to do with that property longer term? Because there could be a difference between, is this going to be the forever home that you're going to be in for the next 10 years plus? Or are you likely to be using this house for as your owner occupied house for a couple of years, and then you're going to want to upgrade and rent this property out? So that's a very common scenario that we see with people, where they'll move into a first home and live there as an owner occupier, and they'll pay off as much of that mortgage as they can, thinking that they're doing the right thing. But then in 2 years, 3 years time, they want to rent that property out. So then they've got a really small debt on that, which becomes their investment property, and they don't have enough cash for the deposit on the next place. So they end up over leveraging to buy the owner occupied house, and they end up with a really big mortgage on the house that they're living in and a very small mortgage on the investment property. Which means that from a tax point of view, completely the wrong way around, because then you've got very little debt that you can actually claim the interest on the first property, which has become your investment, and you've got huge debt on the house that you're living in, which is your owner occupied house. So
Right.
it's important to understand where are you going to be in the next few years, if that's going to be the case, and the first home, because for the vast majority of people, the first home is not the forever home. It's either going to be the investment property in a few years' time, or we might end up selling that house to then fund the next house that you want to live in.
Yeah, that makes sense. So I think that it's so important what you said. And like for those listening, because we get a lot of listeners who will email us or give us a call about, different things they want to hear about. This is something that's often talked about. It's what if I don't know where I'm going to be in 5-10 years? Like, what if I don't know where I'm going to be in 3 years? Like at the moment, I'm happy with what I'm doing, and they're people that aren't really planned. How do you kind of go about finding a structure for someone like that who doesn't really know what they want to do?
Yeah, it can be tricky. There's other considerations for structure as well, such as are we putting down a 20% deposit to try and avoid lender's mortgage insurance, or are we actually putting down a smaller deposit and paying LMI? Which if you've got the cash available, obviously we want to be avoiding lender's mortgage insurance if we can. But if it's going to take you another 12 months to save up your 20% deposit, and we know we're in a market where house prices are increasing, is the right structure for you actually buying the house now and paying a little bit of LMI so that you don't have to pay $50,000 more for the same house next year?
Yeah,
so
gotcha.
So we've got to think about that opportunity cost as well. There's lots of considerations in terms of do we go owner occupied, or do we buy an investment and be a rent investor? What are we doing with that house longer term? Do we want to put down a smaller deposit and preserve that debt and actually put cash in the offset account, so we're saving up cash for the next property? Okay, or are we thinking this is more the forever home and we want to put down as big a deposit we can and pay off the mortgage as quickly as we can and pay less interest? So there's a lot of things to consider. It's definitely not a one size fits all approach, which quite often, if you were going back to that, do I actually just walk into a bank and talk to the local mortgage person in my bank? Quite often that's a one size fits all approach.
Yeah.
Right. We've really got to understand everybody's circumstances are different. Everybody's longer term goals and aspirations are different. And we're going to tailor the advice that we're giving to that client based on their circumstances now and where they see themselves in the next 5 years.
Yeah, that's awesome. And I think that kind of benefit of going to a broker is you do get this tailored approach. And when you're talking to a professional who does this day in, day out for multiple different backgrounds and different walks of life, you're going to get a result that's much more custom and tailored to you. So that's why talking to someone like yourself is going to make so much sense for any, home buyer out there who's not sure. Because like you said, even if they're not sure of what they want to do, then you have to look at all these other parts that go, okay, well, what's the product? How do we determine?
We speak to so many clients and we see people might not be sure where they want to be. So we kind of have to ask the right questions to almost dig a little bit deeper and unpack that. And they might think they're not sure where they want to be, but if we're asking the right questions around, I guess the house that you're buying, is that going to be the right house for you in 5 years' time? Or are you likely to, and it might get a little bit personal, are you likely to be starting a family? Okay, are you going to outgrow this 2-bedroom house and you're going to need to upgrade to a 4-bedroom house later? What are your plans? Are you planning on moving for work? Are you going to be going overseas at some point in time? There's a lot of questions that we can ask to kind of unpack what they are thinking about doing later, which will help narrow down a little bit on that strategy side of things.
Well, it makes sense though, because then even if you're asking those right questions, like you say, even if someone was unsure, you can kind of loosely know what you want to do. Like, look, I want the options open. I know that I definitely want to go on a holiday at some point, whether that's next year or 2 years or 3 years, I don't know. But if they're having that discussion with you and getting to that level of like personal stuff, it means that you're going to have a much better result with your structure as well, in terms of like how you borrow, how you lend, who you go with. And also, if you're not thinking about it yet, now that you're going to be thinking about it and saying, okay, well, hang on. So do you get a lot of buyers that kind of, when you ask those questions, if they're not sure, they kind of go away and think about it and go, no, I think I know where I want to be?
Yeah, definitely. So we'll always, we'll have an initial meeting with the client, which is almost like a fact find. So we're asking lots of questions, we give them lots of information, and then we might then present a couple of different options or a couple of different scenarios to have a think about in terms of, do I want to go and buy a $1 million or $1.5 million house, and these are the repayments, and you're going to have to be comfortable with these repayments moving forward, or are we better off buying the more modest property now, so we're not maxing out your borrowing capacity, and this is what it's going to look like? Or do we go down the rent vesting path? So we'll give our clients lots of information, let them go away and have a think about it, and then we'll get a second meeting booked, where then we'll actually start to look at, well, now that you've had a chance to think about things and you're probably coming back with more questions now, and then we'll really put that strategy in place and then look at options in terms of which bank do we go with and product to rates. So we're always looking at the longer term strategy side of things first, and building that into our advice. And then once we get to that stage of second meeting, we know what we want to do. We've had a chance to think about things, and now we're ready to commit and put it in place.
Nice. And that leads perfectly into my next question, whereas people often get caught up with the product side of things. So now that we've kind of got our structures in place and we know our goals, it's time to look for like the actual loan and who's going to do the lending, right? So people get caught up on chasing the lowest rate, but it's not necessarily the right approach. So what's your kind of approach like in terms of what do you assess for the banks? And I know this can be so situational with client to client, but if we took kind of like a standard, kind of profile of a couple buying a property, maybe they've got a combined income of, 200,000 a year or maybe a little bit less, no dependents. What's the kind of product that, like, what do you look for in a product with the banks that would suit something like that?
Yeah, so it probably is driven more by the complexity of the person's financial position. So if you're really straightforward finances, we've got, 2 clients, both PAYG employees. We're doing the approval based on 2 pay slips. There's not a lot of other debts. There's nobody self-employed. It's really straightforward. Every bank in the country wants that client. So that would more lean into then, well, we're completely agnostic when it comes to banks. We don't have any particular preference. So in that case, we'll narrow down to who are the top 5 or 6 banks that we know are offering good rates right now. Let's negotiate with them. We don't take their first answer because we know that's not their best rate. We'll hit them up a second time and negotiate, and then we'll come back with a list of options as to who you want to go with. So if there's one particular standout with a very cheap rate, then that might be the bank that we'll go with. But also the considerations can then be the customer service that you're going to get from that bank as well. Because there can be some smaller banks who offer particularly cheap rates, but their processes are really clunky. And their application might take an extra 2 weeks compared to one of the major banks. Their online banking might not be great. So there's a few other considerations there. If we get into some of the more complex situations or self-employed clients, well, which banks are open more to self-employed clients, which banks will accept 1-year financials versus 2-year financials, which banks are going to look at business debts or not look at business debts, who can we get you more borrowing capacity within those type of scenarios. So there's a lot of considerations there. And then for the investment clients that we deal with, we kind of know which banks are more open to investment and which banks are more home loan focused. Because if we get somebody who's then looking at, we're now getting to the more complex side of things where we've got our house, we've got a couple of investment properties, and we want to have the ability to sell a property to pay down an owner-occupied house, and then we want to re-gear and do some debt recycling, and there might be some sort of changes of ownership happening as well. That's getting into the complex side of things. And then we can narrow down, well, we know that a lot of the smaller banks just don't even entertain those types of things. We're into some of the major banks who are more investment focused. So there's a lot of different considerations depending on circumstance. We can even look at second or third tier banks. If we can't get enough borrowing capacity with a major bank, is there a smaller bank that actually gives you more capacity but might charge a slightly more expensive rate? So a lot of different things to look at. Like I said, everybody's so different, between the 2 payslip really straightforward application to the super complicated scenario where we might have to email 5 or 6 different banks where this is not even in policy, and can we get the deal done?
I think this is probably why you guys are such a godsend for clients, to be honest, because if you were to go down this path of doing it yourself or just picking one bank to go with, and typically people who do pick the bank, it's whoever they do their personal banking with, right? So if it's the yellow one or the red one, it doesn't matter. But that's what often happens, and then you're kind of lumped into whatever their product is. And if you get a rejection, I think this is important to kind of talk about. Often a lot of clients will go down this path of maybe doing it themselves first, and they'll lodge kind of like a pre-approval application with their bank, and then it gets rejected. And then they go, okay, well, now I'm going to go talk to a broker and see what they can do for me. Does that present any issues when you have to then reapply for that pre-approval? Is there a wait period if they have been rejected?
No issues. You can just because one bank said no, that doesn't mean that you're not a good client, or it doesn't mean you're not going to get approved. It just means that for whatever reason, you didn't fit into that bank's particular policy, or the person that you spoke to at that bank might not have had the expertise to understand how to get the loan approved based on your situation. So there's no issues with going to a bank and then talking to you didn't get approved. You talk to a broker. If you do multiple credit searches, very very incrementally, it's going to negatively impact your credit score, but I wouldn't be too concerned with, I spoke to the bank and they said no, and I went to a broker instead. I think most people now understand the role that a broker actually plays, and rather than going to a bank, they will actually just come to the mortgage broker first of all. And they know that we can present them with multiple options. We know the differences, the nuances between all the different banks' policies, and where can we get this loan approved at this bank versus other banks. So yeah, I don't think that's too much of a problem. We do see that a little bit where someone's been rejected by a bank and then they'll come to us instead. But most of the time they come to us first of all as a broker, and then we won't actually submit an application to a bank until we are 99% sure we can get this approved. Right? We're not gonna waste the client's time by getting documents and application forms filled out and then sending off an application hoping for the best. We want to be really, really certain that we've done our due diligence, we understand the client, we know that it fits in the bank's policy, and if you're submitting this application, we know it's going to get approved.
Yeah, that makes complete sense. And I guess now that we've kind of looked at this, the structure and the options, and let's say someone does secure their home and they've got their loan approved, they've moved in, right? Now, how much later are you checking in with that client when it then comes to that next phase, which is potentially an investment property, or that next property that they might want to go into or buy based on the structure you talked about initially?
So we're quite process driven in that regard. So we touch base with our clients 3 times a year. So once they're a client, they're in a system, we've got a recurring task. So every 3 times a year, every 4 months, there'll be a reach out. How are you? Let us know if you need anything. Get in touch. So we can then look at, and everybody's different. Some people might want to buy a property and then they want to get an investment property really quickly. Other people might take a bit longer. So it is different for everybody. We're regularly keeping in touch with our clients. We're not in the business of we've done your loan and we're not going to talk to you again for the next 30 years. So we want to be in touch with you pretty regularly. Has your house increased in value? Do we want to get it revalued for a number of reasons? If we get it revalued, potentially with you having more equity in your house, well, then we can renegotiate your rates first of all, which is a nice quick win for you. Has it gone up in value? Do we want to then use the equity in that property to then leverage into the next investment property? So for some clients, and this comes into the risk appetite as well, some clients might want to build up an investment property portfolio really quickly. And as soon as they've got more equity in their house, they'll draw that equity up to 80% of the new valuation. And then they'll use that to go in and get an investment property. Some people might even want to draw equity up to 90% and then use that to go and get an investment property. So if everyone's kind of different in that regard, there's no kind of set time frame. It depends on where you buy and what you buy as well. So some markets will appreciate very quickly. So Perth, for example, had
so much growth.
10 or 12 years of no growth and completely stagnant, and then went up massively in the last few years. We've just had Melbourne, which has had kind of 5 years of stagnant or negative growth, and now it looks like it's about to go through a really big growth cycle. So depending on where you buy and what you buy, you might be in a position where, or Brisbane, which has kind of consistently gone up 10% year on year for the last 5 years, you might be in a position where you've got equity really quickly and you want to get into the next investment property, or it might take a bit longer. So it's going to be different for everybody.
That makes complete sense. And this is kind of the importance of what a buyer's advocate does when they're working with your mortgage professional, because everything has to line up, right? So I know I've worked with a lot of brokers when I'm, doing advocacy, and that relationship is key because we're lining up, well, where are they buying? What are they buying? I've also talked to them about goals, but then you've talked to them about their goals. So that relationship is where you kind of really have that sweet spot of buying the right asset at the right, location, and then being able to maximize that asset financially by working with yourself. So it's good that you're following up periodically throughout that time after they've actually done their initial loan.
Yeah, we're in contact regularly, and we know history's told us that the longer you stay with the bank for, then the more chance that you are paying too much on your interest rate. So that at the most basic level of things, we want to be keeping in touch with people regularly because we want to review your rates. We want to hold the bank accountable. We want to make sure that they're giving you as good a deal as they're giving to their brand new customers. And if they're not, we'll look somewhere else for you. So at the most basic level, we're keeping in touch with our clients to make sure that their loan is competitive. But then it's do we want to upgrade? Is it the right time to restructure? Are we looking at buying a bigger home, so we want to change our first loan to interest only because it's going to become an investment property? There's a whole number of things that are going to happen based on your or the client's life cycle. If they've had a big promotion and now they've got more income, and potentially now they're in a position to make the next move because their income's gone up as well.
No, that's so true. I didn't even think of it that way. Like, yeah, you're right. Circumstance changes, like, yeah, promotions. These are all really real things that happen. Sometimes, like, when you're not expecting it necessarily. So it's interesting. I think the next part I want to go through, which is a fan favorite of this show, all of these guys love when we do myth busting. So I throw to you some really common objections that have come from the Oz Property chat on Reddit, property forums, and also our commenters who send us emails. So I'd love to, give you an opportunity to kind of debunk some of these myths that people talk about. Are you ready to play with me?
Yeah, go for it.
All right, let's do it. This first one comes from a Redditor that says, a broker wants to charge me 2% of the loan. Is that normal? So
no,
I guess what fee should they be paying?
No, that's an easy one to do. But no, there's we're not a fee for service model. So so dealing with a broker, there's no cost involved. So we don't charge for our time, for our advice. We will, for full transparency, we will eventually get paid by the bank when you buy a property or we do your refinance. We'll get paid a commission for that loan. There's no cost to you as the borrower. There's no difference in interest rates walking into a bank or coming to me directly. So it should be, yeah, there's no fee for service. They did talk about introducing fee for service during the after the Royal Commission, which would just be a ridiculous idea, because why would you pay a mortgage broker when you can walk into a bank for free? Which would just kill off competition completely. So you want to be able to talk to a broker. Brokers get access to all the banks, and we're not charging you anything for the service.
Yeah, that's awesome, and it makes sense. So I think that was a pretty quick debunk. Shut that down real quick.
That's an easy one.
This next one comes from Reddit once more, and it says, my bank dropped my rate slightly. Should I bother switching for a different bank, like for a different loan, and chase a better rate?
Potentially. It depends what the difference is. So we'll never refinance anyone for the sake of refinancing you, right? So it's pretty open and transparent in terms of the rate that you're getting from the bank, although the banks like to try and hide it and make it difficult for you to try and actually find it online sometimes. But once you know what your rate is, if you're talking to us and we're doing your review, we'll first of all talk to your existing bank and see, is that the best rate you can offer, or can we get you a discount? Because if we can get you a discount with your current bank and we don't refinance you, you save the cost of refinancing, right? So we'll get quotes from your current bank and the top 5 or 6 other banks in the market. So then it can be pretty clear in terms of the rate that you're paying versus the rate we can get you elsewhere, and then what the actual dollar cost savings is going to be. Because if it costs you something like $1,000 to switch banks on average, by the time you factor in discharge fees, government fees, and potentially a application or package fee at the new bank, it's going to make financial sense for you to actually switch.
Yeah, that makes sense. I like that. And also because you're not necessarily wanting them to refinance, like you said, you're just looking at the best option for them first.
Yeah, absolutely. Because if you try and refinance, but you haven't actually spoken to your existing bank already, once they know you're refinancing, they're going to come back and give you a better offer, right?
Yeah.
So we want to find out right at the start of the process what's the best rate you can give this client, because we're going to refinance them, and then we'll get their offer and we'll get the other offers and we'll do a really fair comparison, and that's their opportunity to hold on to you as a client. And then if they're not prepared to offer you a better deal, then these are other options that we've got for you.
Oh, that's awesome. And you put that really well, very simply explained. I think that's clear. And I like this next one. So this came through from one of our listeners. So thank you for submitting. It says, my broker told me to go interest only to maximize borrowing. Is that dodgy?
I wouldn't say it's dodgy, but it's not particularly good advice. So if going interest only reduces your borrowing capacity, it doesn't increase your borrowing capacity. Right, so going interest only will reduce your payments. So your personal cash flow, you're going to have more money in your pocket every month because your repayments on the loan are less, but you're not actually paying off the loan. You're just maintaining the debt at the same level. But from the bank's point of view, it gives you less borrowing capacity. Because if you've got a 30-year mortgage principal and interest, you're paying it off over 30 years, and that's how the bank calculates your payment. If you've got a 5-year interest only mortgage, you're technically paying it off over 25 years. Because the bank knows for the first 5 years the debt doesn't go down, and then we've got to pay it off over 25 years. So in the back end of the bank's calculation, you're actually working out your repayments higher. So I'm not saying interest only is bad. There's a time and a place for interest only, particularly when we're structuring things for investors, when we want to maintain tax deductible debt and reduce non-deductible debt faster. We want the deductible debt on interest only, but it definitely doesn't increase your borrowing capacity by having interest only payments.
Okay. No, that's good to know. And I think that's super important. I hope you're listening there and you heard your question. I'll get back to you on this and refer to the episode because, maybe you need to talk to Lewis. It says here, this next one is from one of the home forums, and it says, I got pre-approval, so I can go unconditional, right? And I think this is the idea of that. If you're pre-approved, it automatically means you're unconditional in the mind of this person, which I don't think is correct.
It depends how much risk you want to take. So first of all, there's two types of pre-approval you can get, right? There's an auto approval from the bank, which is the computer spits it out and says you're approved up to this limit. Okay, that's not a real pre-approval. An actual pre-approval gets eyeballed by a real person. They'll go through your payslips and bank statements and everything else, and they'll probably come back and ask you for more documents, and then they'll give you a pre-approval. That's a genuine pre-approval, not what we call a Clayton's approval, which is not worth the paper it's printed on. But can you go unconditional with a pre-approval? Well, technically you can, because a lot of people will buy at auction. And if you're buying at auction, you're agreeing to buy the property on the day. We're unconditional. There's no finance clause. There's no building and pest clause. And if I pull out of that contract, I'm going to lose my deposit. So a lot of people will go unconditional and go to auction. Some of our clients, once they've got a pre-approval and they're really confident, they might buy a property and waive the finance clause and just do it subject to building and pest. So they're not quite going unconditional, but they're taking some of the clauses out of the contract to make it more attractive. Some people will still want to be really conservative, and even though they've got a pre-approval and we've done all of their financial analysis and the bank's looked at it and they've eyeballed it and they know what they can borrow, they'll still want a finance clause in the contract just to help them sleep at night. So so technically, yes, you could go unconditional if you wanted to, but there's still a little bit of risk there. Even with an auction purchase, you're going unconditional on the day, but you still have the risk that the bank still has to do a valuation on that property. So that valuation could come in less, which means you've either got to find the cash to cover it or you've got to pull out of the contract effectively.
I think auction is a whole other thing I would rant about. I'm not a fan of auctions as an advocate,
really?
To be honest. No, I'm not. Just because they're so emotionally driven, so when you get people that don't really have like a strategy going in, and for a lot of buyers, it's not their fault. They don't know what that strategy is on the day, but it's like having that limit beforehand, the timing of when you bid, how you bid, all the due diligence that comes with buying on the day of auction. There's a lot of pressure because you're also risking, you pay for a building and pest, you might pay for your contract review from the conveyancer. You may not end up buying that property. And sometimes it happens like it's over so quickly, these auctions. It's like within 5-10 minutes, the property's off market and it's gone over for 20,000-30,000 more if there's a lot of people interested. And it's very disheartening for those buyers, and I feel for them. So I'm always like, how do we get it off market before the auction? Let's try and
get an offer before auction for sure. There's definitely risk. I don't see a huge amount of first home buyers going to auction. Particularly if they've not been through the process before, they don't know what the house is worth, it's the first time doing it, so that doesn't really suit them. The benefit is there's transparency, because if you go to auction, you can see what everybody else is bidding, so you know what the actual offers are. When you're buying a property and it's not an auction and the real estate agent says, I've got 5 contracts and your offer's not good enough, like, well, what are the 5? Where do I go from there? Do I go an extra 5 grand? Do I go an extra 50 grand? So you've got no idea. So
thank you for debunking some of those myths. I always like that. I hope you guys listening got a lot out of that. Lewis, I think it's always good to talk about the theory and the structures, but I think I like to bring it to life, with an actual story. Can you share a story where you worked with a first home buyer maybe who set things up well and was able to invest not long after?
Yeah, we've got a lot of clients in that situation. If I think about anybody specifically, so a lot of clients we have helped to buy their first home, and then they might use that equity to then upgrade and get a second property, where what we would do is on the first property, we would help them borrow, say 90% or 95% of the purchase price, because they can avoid lender's mortgage insurance at those levels, and don't aggressively pay off the loan. Just put all your cash in the offset account so that you've maintaining the debt on that property at the highest level that you can, and you're building up your cash in the offset account, because your cash then becomes the deposit for the next property that you want to buy. So we don't want you buying if you're going to go and upgrade and get the $2 million property, we don't want you borrowing 1.8 mil against that property. We want you having as much cash as possible so you can put down a big deposit on that property and not be crushed with massive mortgage repayments on that one. So we've got a lot of clients we've helped do that. I've got a lot of clients that I've actually helped get debt-free in a very short space of time. Or we say a short space of time, it's kind of paying off your house in, say, 7 to 10 years by way of owning a property, and then once you've got equity in that property, using that equity to get investment properties, and talking to buyers agents, professional advisors, so they know they can buy in the right markets at the right time, and then using those investment properties as a tool to sell, pay off your sale cost and your capital gains tax, and then use what you've made on those properties to actually pay down their mortgage.
I love it. And I think super important. Lewis, thank you so much for joining us once again. And I think this has been a really valuable conversation. I can't wait to post this one out. Everyone's going to benefit, especially from your structure. Now, guys, today we covered how structure beats rate, how to set up your first home loan like an investor, but keep the door open. Structure is everything. And whether that's upgrading or investing. So if you want to work with Lewis at the Australian Lending and Investment Centre, or ALIC, all the links are in the show notes. Please reach out to him and have a chat. It costs nothing to have a discussion. And as we've learnt, it also costs nothing to use a mortgage broker. They're paid by the bank at the end. So have a chat. And as always, don't forget to like, follow, share and subscribe to the No BS Real Estate Podcast, wherever you get your podcasts. Thanks for having us. That's a wrap for this episode of the No BS Real Estate Podcast, powered by BOQ AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodi.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search BOQ AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodi.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.